In October 1929, the stock market collapsed and America plunged into the Great Depression. Stocks fell 89% over 3 years. Banks failed by the thousands, 25% unemployment. Breadlines stretched for blocks. It took 25 years just to recover to 1929 levels. In September 2008, Lehman Brothers collapsed and triggered the Great Recession. The S&P 500 crashed 57% in 18 months. Housing values destroyed. 10% unemployment. Banks required trillion-dollar bailouts. Recovery took 5 years. But November 2025 is different. This time, we're not facing one bubble. We're facing what economists are calling the everything collapse. Stocks overvalued beyond any point in history. Corporate debt at levels that dwarf 2008. Real estate more inflated than the housing bubble. And here's what makes 2025 unprecedented. The tools that saved us in 1929 and 2008 no longer exist. The Federal Reserve already used them. The government already spent them. And the mathematics of what's coming guarantee that when this crashes, it will destroy more wealth than any event in human history. What if I told you we're not entering a new crisis? We're in 1928, watching the final year before the Great Depression. Except the crash coming in 2025 and 2026 will be faster, more severe, and affect more people than 1929 and 2008 combined. This isn't prediction, this is pattern recognition, and every single warning sign is flashing red simultaneously. To understand why the 2025-2026 crash will be unprecedented, you need to understand that we're not in one bubble. We're in 4 simultaneous catastrophes that have never occurred together in financial history. The Magnificent 7 concentration bubble. 7 stocks, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, represent 30% of the entire S&P 500. This concentration hasn't existed since 1929, when a handful of industrial stocks held up the market right before it collapsed 89%. When these 7 crash, they take everything down with them. The zombie company debt crisis. As of November 2025, zombie companies, corporations that can't earn enough to cover their interest payments, have hit the highest level since early 2022. Nearly 100 companies gained zombie status in October alone. These aren't small businesses. They're major corporations like Lionsgate Studios that gorged on debt when rates were 0 and now can't service it at 7% interest. When they default, the cascade destroys banks, jobs, and entire industries. The everything valuation insanity. The Buffett Indicator, Warren Buffett's preferred measure of market valuation, sits at 217% to 221% depending on the calculation. Buffett himself said in 2001 that anything above 120% is dangerous. Above 200%, he said, you're playing with fire. We're now at the highest level in recorded history, surpassing even the dot-com bubble peak, the Federal Reserve trap. Interest rates are still elevated at levels where the Fed can't dramatically cut without reigniting inflation. They can't print unlimited money because they just did that from 2020 to 2022 and caused the worst inflation in 40 years. The government can't bail everyone out because federal debt exceeds 125% of GDP with $1.2 trillion in annual interest payments alone. These 4 catastrophes are happening simultaneously. And when they converge between November 2025 and June 2026, the timeline every indicator points to, the crash will be unstoppable. This isn't speculation. This is mathematics. Start with the most visible danger, the Magnificent 7 concentration. Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla represent 30% of the S&P 500's total market capitalization. This means that if these 7 companies crash, they mathematically drag the entire index down with them. There's no way around it. Nvidia alone illustrates the insanity. The company trades at a price-to-earnings ratio above 50, meaning investors pay $50 for every $1 of profit. Nvidia's market value exceeds $3 trillion, making it worth more than the entire GDP of the United Kingdom, the 6th largest economy in the world. This isn't rational valuation. This is pure speculation driven by artificial intelligence hype that mirrors the internet mania of 1999. Everyone believes AI will change everything, just like everyone believed the internet would change everything in 1999. They were right about the long-term impact. They were catastrophically wrong about short-term valuations. The dot-com bubble crashed 78% from peak. Nvidia could easily fall 60% to 80% if AI hype fades or earnings disappoint. That single stock declining would take 7% off the entire S&P 500. But it won't fall alone. When Nvidia crashes, Microsoft crashes. When Microsoft crashes, Apple crashes. When Apple crashes, Amazon crashes. The correlation between these 7 stocks is nearly 100% because they're all driven by the same narrative. AI will generate infinite profits. The moment that narrative cracks, the algorithmic selling begins. High-frequency trading systems will dump positions in milliseconds. Retail investors will panic. Institutional risk management systems will trigger automatic sells when losses hit predetermined thresholds. Within days, the Magnificent Seven could be down 20% to 30%. Within weeks, 40% to 50%. And because they represent 30% of the index, the S&P 500 would fall 12% to 15% from the Magnificent Seven alone. But here's where it gets worse. The concentration risk extends beyond just market capitalization. These 7 companies drive the earnings of the entire index. If you remove the Magnificent Seven from S&P 500 earnings growth, the remaining 493 companies are barely growing at all. This means the entire bull market since 2023 has been driven by 7 stocks. When they fall, there's nothing underneath to catch the market. The other 493 companies can't carry the index because they're not growing fast enough. Historical precedent is clear. In 1929, a small number of industrial stocks held up the market. When they crashed, everything collapsed because there was no diversification of market value. We're in the exact same situation 96 years later, except the concentration is even more extreme. While investors focus on the Magnificent Seven, a quiet crisis is unfolding in corporate America that will trigger the next phase of the crash. Zombie companies, businesses that can't generate enough profit to cover their interest expenses, reached their highest levels in November 2025 since early 2022. Almost 100 companies gained zombie designation in October alone. These aren't obscure small businesses, they're companies you know. Lionsgate Studios, which owns rights to John Wick, The Hunger Games, and Twilight franchises, is a zombie. Tronox Holdings, a major chemical company, saw its bonds fall 9 cents on the dollar after refinancing. CSC Holdings bonds trade below 80 cents, yielding close to 20%, a sign the market expects default. The pattern is simple and deadly. These companies borrowed massively when interest rates were 2% to 3% during the pandemic era. They used that cheap debt to fund operations, acquisitions, and expansion. But they never became profitable enough to pay back the debt. Now their loans are coming due. And when they try to refinance, banks are quoting them 7% to 9% interest rates instead of 2% to 3%. A business that barely survived at 2% interest is bankrupt at 8% interest. The math doesn't work. According to Bloomberg, many zombie companies now come from healthcare and biotech sectors facing soaring costs and reduced federal subsidies. Others are exposed to tariffs that destroyed their profit margins. The common thread? They all have massive debt that needs refinancing at rates they can't afford. Bank of America strategist Michael Hartnett points to an alarming shift. Even the tech giants, Amazon, Alphabet, Meta, Microsoft, and Oracle, are increasingly funding capital expenditure with debt rather than cash flow. They're projected to spend $400 billion in 2025 and $520 billion in 2026 on AI infrastructure, much of it financed through borrowing. If tech giants are borrowing to fund growth instead of using profits, what does that tell you about the sustainability of the AI boom? A Morningstar DBRS report shows nearly 30% of middle market borrowers are experiencing financial stress. Payment-in-kind arrangements, where companies defer interest payments because they can't afford them, rose from 6% in 2022 to 11.4% by mid-2025. This is subprime corporate lending. Companies that can't pay interest are rolling debt forward, hoping something changes. It won't. When the recession hits in 2026, these companies default in waves. When zombies default, banks holding their debt realize losses. Regional banks are most exposed because they lent heavily to middle market companies. In 2023, Silicon Valley Bank, Signature Bank, and First Republic Bank all failed within months of each other, even though we weren't in recession. When the 2026 recession hits and loan defaults surge, dozens more regional banks will fail. The FDIC insurance fund has only $125 billion to cover approximately $10 trillion in deposits. If multiple large bank failures occur simultaneously, the FDIC is overwhelmed within weeks. The government would have to print money to cover deposits, which starts the inflation spiral that destroys the currency. This is the doom loop. Corporate defaults trigger bank failures, which trigger government money printing, which trigger inflation, which trigger more corporate defaults. There's no escape once it starts. While zombie companies prepare to default and the Magnificent Seven sit overvalued, the broader market has reached valuation levels that occur once every few generations. The Buffett Indicator, the ratio of total stock market value to GDP, currently sits at 217% to 221%, depending on the data source. Warren Buffett called this metric probably the best single measure of where valuations stand at any given moment in a 2001 Fortune interview. Buffett said that a ratio of 70% to 80% represents a good time to buy stocks. A ratio above 120% suggests overvaluation. A ratio approaching 200%, he said explicitly, means you're playing with fire. We're now at 217% to 221%. This is the highest level in recorded history. higher than the dot-com bubble peak of 137% to 160%, depending on calculation, higher than the 2021 peak, higher than any point since they started tracking this data in the 1940s. What does this mean in practical terms? It means the stock market is valued at more than double the size of the entire U.S. economy. Every dollar of economic output is somehow worth $2.20 in stock market value. This ratio cannot be sustained because economic output and corporate profits are linked over time. For the stock market to justify a 220% ratio, corporate profits would need to double as a percentage of GDP. That's not happening. Corporate profit margins are already at all-time highs. They can't go much higher without triggering political backlash or regulatory intervention. The Shiller PE ratio, which uses 10 years of inflation-adjusted earnings, currently sits at 39.86 as of late September 2025. The historical average since 1871 is 17.28. We're at 2.3 times the historical average. A Shiller PE above 30 has only occurred 6 times in 154 years of data. 5 of those 6 times preceded market crashes ranging from 20% to 89%. The current reading of 39.86 is the third highest level in 154 years, exceeded only by the 1929 peak and the 2000 dot-com bubble. Stock market price-to-sales ratios recently hit 3.33, an all-time record according to Bespoke Investment Group. For comparison, the dot-com peak reached 2.27. The post-COVID boom peaked at 3.21 before crashing in 2022. We've now exceeded both previous bubbles. Warren Buffett himself is responding to these valuations by hoarding cash. Berkshire Hathaway's cash position exceeds $325 billion, the highest in the company's history both in absolute terms and as a percentage of assets. Buffett has been a net seller of stocks for 11 consecutive quarters, totaling $177.4 billion in net sales. When the world's greatest investor is sitting in cash at record levels, refusing to find attractive investments, what does that tell you about valuations? Insider selling at the Magnificent Seven companies has reached extremes. Jeff Bezos sold over $13 billion of Amazon stock in 2024 and 2025. Mark Zuckerberg has been selling billions of Meta stock. NVIDIA executives sold shares even as the stock hit new highs. Insiders have access to information ordinary investors don't. They see the real earnings, the real pipeline, the real competitive threats. When they sell in massive quantities, it signals they don't believe current prices are sustainable. This happened in 1929 before the crash. It happened in 2000 before the dot-com collapse. It's happening again now. The most critical difference between 2025 and previous crashes is that the Federal Reserve has no tools left to stop the collapse. In 1929, the Fed could have cut interest rates aggressively, but didn't understand what needed to be done until too late. In 2008, the Fed cut rates from 5.25% to 0 and implemented quantitative easing, buying trillions in bonds to inject money into the system. In 2025, the Fed is trapped. Interest rates are currently in the 4.5% to 5% range. The Fed can cut, but not to 0 without reigniting inflation that only recently came under control. Inflation peaked at 9% in mid-2022, the worst in 40 years. It took painful rate hikes and economic slowdown to bring it back near the 2% target. If the Fed cuts rates dramatically in response to a crash, inflation surges again. If they don't cut, the economy plunges into depression. There's no middle path. Both choices lead to catastrophe. Quantitative easing is similarly constrained. The Fed's balance sheet already exceeds $7 trillion after multiple rounds of QE following 2008 and again during COVID. The 2021-2023 inflation proved that you can't print unlimited money without destroying purchasing power. Everyone now understands that printing money causes inflation. The political and economic backlash to another round of massive QE would be severe. And unlike 2008, when the Fed could print money because inflation was low, printing in 2025 would occur when inflation is still elevated and vulnerable to resurging. The government bailout capacity is exhausted. In 2008, federal debt was 67% of GDP. The government could borrow to implement the Troubled Asset Relief Program and other bailouts totaling close to $2 trillion. In 2025, federal debt exceeds 125% of GDP at over $36 trillion. Annual interest payments on this debt now exceed $1.2 trillion, making it the single largest line item in the federal budget. Larger than defense, larger than Social Security. The government doesn't have another $2 trillion to bail out failing banks and corporations. If they try to borrow it, bond markets revolt and interest rates spike even higher, making the debt service even more unsustainable. This creates a doom loop. The government needs to borrow to bail out failures. Borrowing drives interest rates higher. Higher rates make the debt service larger. Larger debt service requires more borrowing. The cycle accelerates until either the government defaults or prints money and destroys the currency through hyperinflation. Recent economic data from the Conference Board shows the leading economic index declined 0.5% in August 2025, the largest monthly decline since April 2025. The LEI fell 2.8% over the 6 months from February to August, accelerating from a 0.9% decline in the previous 6 months. The Conference Board, while not officially forecasting recession, expects GDP growth of only 1.6% in 2025, down sharply from 2.8% in 2024. They cite tariffs as a major drag that already trimmed growth in the first half of 2025 and will continue weighing on the economy through the first half of 2026. The window's closing, the indicators are deteriorating, and the Fed has no ammunition left to fight what's coming. The timeline for the crash is remarkably clear when you understand how recession indicators work. The Somm rule, developed by economist Claudius Somm, has predicted every recession since 1970 with no false positives. The rule triggers when the 3-month moving average of unemployment rises 0.5 percentage points above its lowest level in the previous 12 months. In mid-2024, unemployment triggered the Somm rule, reaching 0.53, then 0.57. The indicator has since fallen back, and Somm herself suggested it may have been a false alarm, but economists in Bankratia's Q3 2025 Economic Indicator Survey forecast unemployment will climb to 4.6% by September 2026. If unemployment rises from 4.1% currently to 4.6% by September 2026, the Somm rule triggers again. And when unemployment starts rising, it accelerates rapidly as layoffs trigger more layoffs. UCLA Anderson School of Management issued a formal recession watch in March 2025. They identified multiple simultaneous risks: tariff policies causing manufacturing contraction, weakened household spending, an exuberant financial sector with elevated asset valuations paralleling the dot-com bubble, and the threat of stagflation if the Fed must raise rates to combat tariff-induced inflation. Mark Zandi, chief economist at Moody's Analytics, warned in October 2025 that states representing nearly 1/3 of U.S. GDP are already in recession or at high risk. Michigan moved from treading water to recessionary as auto industry tariffs bite. Another third of states are barely growing. Zandi stated bluntly, "The U.S. economy is not in recession, but it is struggling to avoid one. This is evident in the job market as payroll job growth has come to a virtual standstill. First quarter 2025 GDP declined 0.3%, though this was revised territory with significant tariff impacts. The Atlanta Fed's GDP Now tool, which provides real-time GDP forecasts, has shown significant volatility, at one point projecting negative 2.8% growth before recovering. Consumer spending, which represents 70% of the economy, is weakening. Both Walmart and Target warned in early 2025 that tariffs will force price increases and that consumers are pulling back, choosing store brands, and delaying big-ticket purchases. Credit card debt exceeds $1.14 trillion, an all-time record. The average household carries $6,800 in credit card debt, with interest rates averaging 20% to 28%. Credit card delinquencies have risen to levels not seen since 2011. Auto loan delinquencies hit 7.5%, the highest since 2009. Average monthly payments exceed $740 on loans stretched to 84 months. This is subprime auto lending, creating the same cascade as subprime housing in 2008. Commercial real estate sits in crisis. Over $2 trillion in commercial mortgages come due during 2025. In 2026, needing refinancing from 3% rates to 7% to 9% rates. Office buildings sitting 45% vacant can't support debt service at triple the interest rate. Defaults have already begun at major institutional owners like Brookfield Asset Management. The pattern is unmistakable. Consumer spending weakening, corporate debt unsustainable, commercial real estate defaulting, banks exposed to massive losses, unemployment rising, GDP growth collapsing. Every indicator points to recession beginning between December 2025 and mid-2026. Here's exactly how it unfolds when the crash begins. The trigger could be anything: a disappointing earnings report from NVIDIA or another Magnificent Seven company, a larger than expected regional bank failure, an escalation in geopolitical conflict, a breakdown in debt ceiling negotiations. The specific trigger almost doesn't matter because the system is so fragile that any shock starts the cascade. When NVIDIA or another tech giant misses earnings or provides weak guidance, algorithmic trading systems sell instantly. The stock drops 10% to 15% in a single day. Because NVIDIA represents 7% of the S&P 500, that alone takes the index down to 0.7% to 1%, but the psychological impact triggers selling across all 7 magnificent stocks. If the AI narrative that drove valuations starts cracking, investors question whether Microsoft, Apple, Amazon, and Google can justify current prices. Within days, the Magnificent Seven could decline 20% to 30%. This 30% decline in stocks, representing 30% of the index, means the S&P 500 falls 9% from the Magnificent Seven alone. But it triggers 3 additional cascade mechanisms. First, margin calls. Investors who bought stocks with borrowed money see their positions decline. Brokers demand additional collateral. Investors who can't provide cash have their stocks sold automatically. This forced selling drives prices lower, triggering more margin calls. Second, institutional risk management. Pension funds, endowments, and hedge funds have automatic selling triggers when portfolios decline beyond certain thresholds. These aren't emotional decisions, they're programmed responses. When stocks fall 20%, computer systems trigger sales to prevent further losses. Third, retail panic. Ordinary investors watching their 401ks and IRAs decline 20% to 30% in weeks start selling. They remember 2022 when stocks fell and didn't fully recover. They panic and lock in losses. Within the first month, stocks could easily be down 35% to 45% as these 3 mechanisms feed on each other. The crash moves from stocks to bonds. Investors flee to treasury bonds seeking safety. But the government needs to issue trillions more bonds to cover deficits and refinance maturing debt. If there's a flight to safety at the same time the government needs to sell bonds, supply overwhelms demand and yields spike. Higher yields mean the government's interest payments increase, requiring more borrowing, which requires issuing more bonds, which drives yields even higher. This doom loop typically ends in either default or currency collapse through inflation. Housing markets freeze as buyers disappear and sellers refuse to accept lower prices. Within 6 months, home prices could be down 25% to 35%. Within a year, declines of 45% to 55% are realistic in overvalued markets. Commercial real estate defaults accelerate as owners realize they can't refinance. They hand keys to lenders, typically regional banks. Banks realize massive losses that wipe out capital. When capital ratios fall below regulatory thresholds, regulators close banks. Bank failures create panic. Depositors rush to withdraw money from any bank perceived as risky. Even healthy banks don't have enough cash to pay all depositors simultaneously. They must sell assets at fire sale prices, creating losses that can turn healthy banks insolvent. The FDIC steps in, but the $125 billion insurance fund is inadequate. The government must print money to cover deposits. And that starts the inflation process that destroys the dollar's purchasing power. Employment collapses as companies cut costs through layoffs. Tech companies eliminate 15% to 25% of workforces. Finance companies heavily exposed to market declines cut staff. Retail companies facing customers who can't spend close stores. Within 3 months of the crash starting, unemployment rises from 4% to 7% or 8%. Within 6 months, 10% is realistic. Within a year, 13% to 16% unemployment matches. Great Depression levels as cascading failures move through the economy. So why is the 2025-2026 crash worse than 1929 and 2008 combined? Because we have the concentration risk of 1929 in the Magnificent Seven, the debt bubble of 2008 in corporate zombies and real estate, the government debt crisis that didn't exist in either previous crash, and all 3 are happening simultaneously while the Fed has no tools left. In 1929, only 10% of Americans owned stocks. The crash directly affected a small percentage initially. In 2025, 58% of households own stocks through 401ks and IRAs. When the market crashes 60% to 70%, it directly destroys retirement savings for more than half the country. In 2008, the Fed could cut rates to 0 and print $4 trillion without causing inflation. In 2025, rates are already low and inflation is still elevated. The Fed printing money again triggers the inflation spiral that makes the great inflation of the 1970s look manageable. In 1929, the government had no debt and could respond with fiscal stimulus. In 2008, the government debt was manageable at 67% of GDP. In 2025, debt exceeds 125% of GDP with $1.2 trillion in annual interest payments. The government has no capacity to bail out failures. The 12 warning signs aren't speculation. The Buffett Indicator at 217% is a fact. Zombie companies at highest levels since 2022 is a fact. The Magnificent Seven representing 30% of market value is a fact. Warren Buffett hoarding $325 billion in cash is a fact. The Conference Board leading economic index declining is a fact. The timeline is clear. Recession indicators point to December 2025 through mid-2026. Commercial mortgage refinancing peaks in this period. Consumer debt defaults are accelerating now. Unemployment is rising. GDP growth is collapsing from 2.8% to 1.6% to potentially negative. When the crash comes, stocks will drop 65% to 80%. Bonds will drop 30% to 45%, something that didn't happen in previous crashes. Real estate will drop 45% to 60%, worse than 2008's decline. Unemployment will exceed 15%, and recovery will take not 5 years like 2008, but 15 to 25 years, because the Fed has no tools left, and then the government has no borrowing capacity left. The everything crash earned its name because everything crashes together. Stocks, bonds, real estate, employment, all declining simultaneously with nowhere to hide. The mathematics of unpayable debt, historic overvaluation, zombie corporations, and exhausted policy tools guarantee it. The crash is coming. The only question is whether you'll be prepared when it arrives.